and welcome to S&W The Pulse. My name's Amy Jack, Head of National Tax, and as usual I'm joined by my two excellent co-hosts, Liz Hudson, who works with our private client tax teams, and Gina Hetherington, who works with our business tax teams. This is our Talking Tax segment where we help you stay up to date with changes in the world of tax. And if you haven't listened to Talking Tax before, what we do is discuss one or two tax topics in a bit more detail, and these won't necessarily be breaking news, but areas that our clients are thinking about now. And in this episode, we'll be talking about property-related issues for non-residents. And I'm delighted that today we are joined by Zoe Thomas, the head of our real estate sector for tax. As usual, we'll also have a roundup section where we'll highlight some of the recent changes, and this time we're looking at the election manifestos and the recent decision in Higgins, one of Liz's favourite cases. But just turning to our main topics, one of the reasons we wanted to talk about the recent property tax changes is because they have such a wide impact. When you make changes to the way property is taxed, it impacts homeowners, investors, funds, companies, and other categories too. It's also an area that's changed a lot in recent years. But today, one area we're going to focus on is the expansion of non-resident capital gains tax, or NRCGT. These rules were originally introduced in 2015, and when they came in, it meant that all non-residents were taxed on disposals of UK residential property. And now, or from April this year, there's a further extension to include commercial property. And I'm going to ask Liz first to tell you a bit about these changes, as she has been working closely with our private client tax teams to understand the impact.
Thanks, Amy. So as you said, we've had the concept of non-residents paying capital gains tax for a little while now, although the previous rules only applied to the disposal of UK residential property. There are also exemptions from the charge, so for widely held companies and widely marketed collectives, and the changes we're talking about today all came in from 6th of April 2019. And at that point, all of the old non-resident CGT rules were repealed and they were replaced with a new set of much wider rules. And these new rules introduce this idea of a new single regime. It covers all non-resident persons, so individuals, including partners in partnerships, trustees and companies, including some deemed companies. And what the rules do is they bring all these non-residents into the charge to tax on gains on a disposal of interest in any land. The exemptions for widely held companies are gone, and as you mentioned, it's all land. So commercial properties now also in scope. So garages, woodland, farm buildings and farmland, for example, offices, warehouses, factories, etc.
And the new regime also extends the rules to indirect disposals as well. So, for example, you might have a non-resident who has shares in a company and that company owns UK property. And this seemed to be one of the more complicated aspects of the rules, I thought.
Yeah, it is quite a complex area. So the new rules apply where the seller owns a right or interest, so for example shares in a property-rich company. And a property-rich company is one where at least 75% of the gross asset value of the company at the time of disposal is derived from UK land. And that can be directly or indirectly, so there's tracing down through underlying entities, and that can be quite tricky. You also generally need to own a 25% or more interest at the date of disposal or any point in the 2 years prior to that date, and that also can include some connected parties' interests. I mean, I would have thought that it's quite likely that people will accidentally miss this reporting. So, for example, non-residents may own shares in non-UK companies owning UK property, and they may well be unaware of these new rules. There is a trading exemption for these indirect disposals, and Zoe, I think you've looked at this quite a lot, so you may want to talk about that a bit more.
Yeah, thanks. It is a really important exemption actually, because it will mean that a number of companies that are actually trading won't actually fall within these new rules. So a company will qualify for the trading exemption, and if it does, it won't be classified as property rich regardless of the percentage gross asset test. So therefore it would be really important for people to look to see if they qualified for this. The trading exemption applies where at least 90% of the UK land being disposed of is used in a qualifying trade. If it is, then the rules to disposals of interest in property rich entities will not apply. I suppose a qualifying trade is one where somebody is looking at something like a hotel trade where you're actually using the property to carry on a business. So the revenue has said that, you know, if you are carrying on, the company is carrying on a trade using the UK land at the time of the disposal, or has been for at least the year prior to the time of the disposal, and the disposer can reasonably conclude that that trade will continue after it has disposed of the land, then you will be able to say that you're pool in the trading exemption and on a commercial basis, so therefore you won't have to be taxed under the new rules. The guidance is still draft on the trading exemption, so they could be subject to changing clarifications, but I do think it's such an important exemption for companies, they should really look in to see whether they can comply with it.
Yeah, thanks Zoe. It sounds like in many cases there'll be quite a bit of work to do to figure out whether or not the rules apply. And I think the point you made, Liz, about people not realising about the rules and so not complying with them is a good one. I think particularly for those that don't have tax advisors in the UK. In terms of mitigating the impact, there are a couple of key points to consider, aren't there? Rebasing and relief under double tax treaties.
Yep, so as you say, there's rebasing, and that means that only the increase in value from the rebasing date is subject to CGT. The rules are quite complex, but basically there's automatic rebasing to 6th of April 2019 for any sales of either property-rich shares or commercial property, so assets that weren't within scope of the old rules. There is an option to elect to use the actual cost if that produces a lower gain. If it's residential property owned directly, the rebasing is as it was before to 6th of April 2015, assuming it was held at that time. So in that case, the rebasing rules as they used to be under the old rules. You also mentioned double tax treaties, and there can be relief under these. Not all treaties allow the UK to tax indirect disposals, so it's really worth checking the terms of the specific treaty and the UK's rights under that treaty.
And as you'd expect, there's also targeted anti-avoidance rules which can counteract planning to get around this charge.
Yeah, there is, and it's worded quite widely, so it could potentially catch a whole raft of planning.
And I know that you and Gina have both spent time looking at the rules. Can you tell us a bit more about the difference between individuals and companies?
Yeah, if I start maybe, and then Gina, you can jump in with the corporate bits. So for individuals and trustees, they'll pay non-resident CGT at capital gains tax rates. And the distinction between sort of residential and non-residential property has largely now gone following the change in the rules, but it is still relevant for the rate of CGT payable on these disposals. So the higher rates of 18 and 28% apply to sales of residential property, and the definition of what's a residential disposal, that hasn't changed. It's still in line with what it was under the old rules, although it was entertaining to see it moved all the way in the legislation from Schedule B1 to 1B. Other direct disposals, such as commercial property and any indirect disposals, whatever underlies it, whether it's residential or commercial, is taxed at 10 and 20%.
From a company perspective, tax is payable at the corporation tax rates rather than CGT. So this is currently 19%, and the planned reduction to 17% from April 2020 is now very unlikely to go ahead. An unusual compliance aspect to be aware of for disposals in the period to April 2020 is that a one-day accounting period is likely to arise. Now, this is because the non-resident company will cease to be within the scope of UK corporation tax immediately following the disposal. And as a result, there are some tight deadlines to bear in mind. So companies need to register for corporation tax within 3 months of the disposal. Tax will be payable 3 months and 14 days from disposal. But there is a bit more time to submit the tax return, and this is 12 months from the date of disposal. There's no requirement to submit annual accounts for the return. But what's quite important, where there are multiple disposals over the year, a new return and payment is required for each disposal. That's except in some very limited circumstances which only apply to collective investment vehicles. There is no requirement, however, to notify and file a return with HMRC where there is no gain or loss or an exemption applies. For example, if there's substantial shareholding exemption on a sale of shares, or there is a no gain, no loss intergroup transfer. Lastly, these compliant aspects are going to change again. for corporate non-resident landlords from April 2020, as both chargeable gains and rental profits will then be subject to corporation tax. So the usual corporate tax rules for e-filing payment of tax will apply, rather than the unusual one-day accounting period which I've just discussed.
Yes, and we'll be covering the implications for corporate non-resident landlords in a bit more detail a bit later.
So as well as the rates being different for individuals and corporates, the compliance side that Jean's just been talking about for corporates, it's also very different for individuals and trustees. There's very tight deadlines for reporting. So a return needs to be filed within 30 days of completion to report the disposal, and that's regardless of whether there's any tax to pay. There is a specific exemption, as Gina just mentioned, for corporates for reporting on no gain, no loss transfers. So, for example, transfers between spouses, there's no reporting requirement in that instance. In terms of when tax needs to be paid, that also generally needs to be paid within the same time frame, so 30 days of completion. For the 2019-20 tax year, there's a slight relaxation for those already in self-assessment, but that goes away from 6th of April 2020, and at that point, all payments will be due within those 30 days of completion. And it's important to remember that HMRC has charged significant penalties for not reporting sales in a number of cases since these rules were introduced back in 2015, even though in many of those cases there wasn't any tax payable. So non-residents really should be aware of these new rules, and they do need to meet these reporting requirements.
Yeah, I totally agree. And just moving on slightly, something that Gina touched on a minute ago, I think we should talk about the specific rules for funds. There was a lot of concern about the impact of these rules on the funds industry, and those concerns were largely addressed by the introduction of 2 elections. And Zoe, I'm sure you'll want to comment here on what the impact will be for funds now.
Yes, as you say, the CIV rules are complex and the legislation is subject to ongoing consultation at the moment. But yes, essentially there are 2 elections which may be available to CIVs, the transparency and exemption election. The elections are effectively moving the taxing point from the disposal to the investors to avoid the potential double taxation at the time of disposal, because most people were concerned that if you've got a corporate, you're then taxing the corporate in the UK. When the investors then sell their shareholding, they're also then going to be taxed, or if they've got units, that kind of thing. So there'll be a double layer of taxation. That is the key thing that everyone is concerned about. The Revenue have addressed this by introducing this transparency and exemption election, and they're still taking on feedback from everybody at the moment because it's not straightforward and there are complex rules around it. I suppose the main things to be aware of is that there are various administrative requirements for making the relevant elections and ongoing reporting requirements for the CIVs to benefit from the elections. But the most important thing to note is that without the election, the CIV will be taxed as a company, so will pay corporation tax when disposing of the UK property or an interest in property-rich entities. And I suppose in respect of the transparency election, it's important to realise that it is irrevocable and consent of all investors would be required. And HMRC have actually noted themselves that it's unlikely that this exemption would be suitable for CIVs that are widely held and have regular changes to their investors, because every time an investor comes in and out of a fund, they could potentially be disposing of their interests as well as other investors' interests. So it's just not going to be kind of feasible, I think, for those types of funds. In respect of the exemption election, it's currently only available to non-UK resident CIVs, and also there are quite significant requirements, kind of reporting qualifications to be able to qualify for this exemption, and you need to make sure that your ongoing reporting requirements and maintaining those requirements and criteria, otherwise you fall outside of it and the Revenue can take that exemption away from you, which means that you could be taxed, kind of go all the way back to the point there's a deemed disposal on those. So that, I think, would be make investors really concerned. They've really got to monitor, so the fund manager will make sure that they are meeting all the requirements set out.
Yeah, thanks, Zoe. We obviously need to consider the investor's position too. They'll obviously be impacted by the changes, particularly because the 25% minimum doesn't apply for investors in collectives. So these rules are likely to affect a wide range of people.
Yeah, they are, and there's been quite a lot of concern in this area recently. So generally the investor is taxed when he disposes of his shares in the CIV. and that's unless the CIV is a partnership or a fund that's made a transparency election, as Zoe just talked about. In that case, the investor will either be taxed on gains when the underlying entity makes a disposal, or again, as Zoe talked about, perhaps when there's a change in the investor. It's also important to remember that while these rules only apply to non-residents, if they're selling shares in a company or a fund, it's not just offshore ones, they can be offshore or UK. So a non-resident will be caught by these rules if they sell shares, for example, in UK REITs, and that's a unit trust investing in real property. So there's two important differences when the disposal is of a CIV rather than sort of your normal company. So first of all, as you just mentioned, Amy, the 25% minimum we talked about doesn't apply for CIV investors. So if a non-resident sells an interest, for example, in a UK REIT, whatever the level of their interest, it could just be like 0.1%, there may then be a 30-day reporting and tax payment requirement. The other difference for CIVs, which may help a little, is that reporting is not required for every disposal in the way it is for other indirect disposals. So very broadly, the 30-day reporting and payment is only needed if there's tax actually payable. The rules are more complicated than that, but that's sort of an overview. So for example, if there's a loss on the disposal of shares in a CIV, then there isn't a reporting requirement, whereas there would be if it was just shares in a company. If there is a loss, you still might want to make a report to claim that loss. And as I mentioned before, with indirect disposals generally, we are concerned that disposals of UK property-rich entities, especially CIVs, may not always be obvious, and the reporting deadline might easily be missed. So non-residents who have investment portfolios might want to liaise with their investment managers to ask for confirmation on whether they hold any investments that might be subject to these new rules.
Good idea. Zoe, what are people doing in practice to deal with these rules?
So the majority of CIVs are going for the exemption election if they aren't able to meet the trading exemption. This does mean that there will be additional admin burden that must be monitored and complied with on a regular basis, and typically this is being outsourced to advisors or one of the in-house finance team are given the responsibility for any of their regulatory filing and reporting requirements.
Moving on to a different topic, but still on the property theme, corporate non-resident landlords will soon be subject to corporation tax and not income tax, as is currently the case. And this will transform the way that non-resident landlords handle their UK tax affairs. And it's not just about the rate at which tax is paid, but there are a huge number of additional areas that non-resident landlords will need to consider or deal with as a result of moving within the corporate tax regime. It results in a much heavier compliance burden, and that obviously adds cost. Gina, the rules for calculating profits for UK property businesses are broadly the same, aren't they? So what do you think the most significant changes that non-resident landlords will see?
Well, I think the most significant change is the way relief will be given for interest expenses and finance charges. These costs will now fall within the corporate debt provision. So in addition to thinking about transfer pricing adjustments, there could be restrictions to interest under anti-hybrid mismatch or corporate interest restriction rules. This could result in a significant reduction in the level of interest that is deductible, particularly for highly leveraged companies or where there are large shareholder loans.
So that could result in a real cost to those companies that are affected by the rules. We have seen some companies look at potential planning points recently, but I think it's fair to say that not everyone affected is adequately aware of the impact of these changes. And clearly there's not a huge amount of time left before the changes are due to take effect, so companies will need to act quickly if they want to consider making any changes. Gina and Zoe, can you share with our listeners some of the points that should be considered now?
Well, I think there are three main things. The first is around the corporate interest restriction rules. If net interest costs in 2020 are expected to exceed 2 million, either in the non-resident company or across the wider UK group, there may be a disallowance of up to 30% of the company's taxable profits. So if this is likely, I think it is worth considering how funding is structured around the group and whether certain loans should be capitalised instead. The second issue is the corporate anti-hybrid rules. So tax relief can be restricted where a tax mismatch arises. For example, where you have a financial instrument which is treated as equity or non-taxable in one jurisdiction, but as a debt and deductible in another. So as a result, I think it is really important that a review of how the entities and financial instruments involving the non-resident landlord are taxed in each jurisdiction to see if these rules may apply. Lastly is losses. So after April 2020, there is an annual 5 million loss utilisation cap. So where future losses of more than 5 million are forecast in the non-resident company or wider group, an analysis should be undertaken to see when these losses are likely to rise and if their use is likely to be restricted. Brought forward income tax property losses are not subject to this 5 million cap, but they do need to be used in priority to later losses. They can't be offset against chargeable gains or other UK profits. So what we're going to have is streaming, and this is going to add to the compliance burden for companies.
And there are also loads of transitional rules to consider on filing and administration, which obviously adds further complication. I think it's a bit more uncertain than we might have hoped for at this stage because we're still waiting for HMRC's guidance, which we now understand is unlikely to be available before January. But there are certain things that we do know, such as that for the 1920 tax year, 2 tax returns will need to be completed, one for income tax and one for corporation tax.
Yes, and we know that HMRC will be issuing all existing companies with a unique tax reference in early 2020, generated for the income tax record. So companies are going to be automatically registered for corporation tax. But this doesn't apply for the existing agent authorisations. These will not carry forward into the corporation tax regime. So agents will need to re-register for each non-resident company. As you say, a final income tax return is required for the 1920 tax year. This is due for filing by January 21, and then along with any final balancing payment not already settled on account in January and July 2020. The first corporation tax accounting period will commence on 6th of April 2020, and under the corporation tax rules, property business profits are calculated by reference to accounting periods, and this is aligned to the company's financial statements rather than the tax year. So for the first year, time apportionment of profits may be required if the accounts are not drawn up to a 5th of April year end. Now for companies, their tax return must be filed online, and this is within 12 months from the end of the accounting period. The tax liability is typically due 9 months and 1 day of the end of the accounting period, but larger companies will need to make estimates and pay their liability in quarterly instalments. For the transitional year, for the first year starting April 20, no instalments are required. I think what is important is for companies to understand the changes in filing requirements and also budgeting for these additional compliance costs. A fundamental difference is going to be the requirement to prepare financial statements suitably tagged in an IXBRL format, and this will include reports to the directors and the auditors. The accounts need to be in English, and they will need to be e-filed along with the corporate tax return and supporting computations. There may also be a requirement to submit consolidated worldwide balance sheet and P&L, along with the P&L for the UK property business. We are actually waiting for more clarity on this from HMRC, but what is clear, there will be a much higher level of disclosure to HMRC going forward.
Yeah, and I suppose from anecdotally from my clients that I'm seeing, I think from what you talked about on the hybrids and the corporate interest restriction rules, that is a real issue because I'm going out to a number of clients and they're just not realising that they actually fall within the anti-hybrid and the structures that they've got up in terms of kind of intercompany loans and flowing through structures, many of them Jersey and Guernsey related, that they're just not going to get the deduction. And so I've done a lot of modelling to kind of show them how it's going to have an impact on them, and it's really quite shocking for them to realise, which then means they've got to, I suppose, report back to their investors as well that they're not going to get the returns that they had hoped to do so. So I think actually there are a number of my clients have started to realise actually they've got to pick up and kind of realise what they're going to do and actually start to model this going forward, because all of the models they've had previously are now going to be out of date and they really need to start to see the impact it's going to have on them, because it will also change their cash flow as well. The other thing that I think is important to add is in terms of, I suppose, on the filing stuff. I think there are a huge number of overseas investors that are investing in the UK property market via non-residents that they have done for so many years that actually the compliance burden involved is going to be significant, way beyond what anyone has ever considered, and that's, they will have smaller advisors that haven't even had a chance to talk to them about it, just because they're overseas, don't even realise that they're going to be caught by it. So I can see that the next year or so is really going to be an interesting transition for people, because there are so many changes. It's not just the tax in terms of capital gains and the changes in this, it's all around admin as well. I think it's going to be real issues for people.
Yeah, certainly a lot to think about. And now on to our tax roundup for this episode. The first thing is that we now have manifestos for most of the political parties, so we have a much better idea of what each of the tax policies are. We don't have time to discuss them in detail, but there are a couple of points I'd like to draw out. For personal tax, there's quite a bit of contrast between the main parties, particularly if you're comparing Conservative and Labour, where Labour's plans contain a number of significant changes. It's worth pointing out that both Labour and the Lib Dems talk about aligning capital gains tax and income tax. But interestingly, there are very few proposals that relate to inheritance tax that we've seen. On the corporation tax side, it looks like the rate will either stay as it is or increase to somewhere up to 26%. And one final point is on entrepreneurs' relief. Labour pledges to scrap it and the Conservatives to review and reform it. So I think that's one area that we are likely to see some change. We have got more detailed summaries on our website, so if you do want to know more, you know where to look.
And then I'm going to talk about the Higgins case, which, Amy, as you said earlier, is one of my new favourite cases. So we've just had the Court of Appeal decision in the Higgins case, which I have been eagerly waiting for. This is the case where a taxpayer bought a flat that has yet to be built, and as a result, he exchanged on the property over 3 years before completing. So the case was about whether his period of ownership for private residence relief purposes started from exchange, and that's what HMRC argued, because that resulted in some capital gains tax on sale, or completion, which is what the taxpayer argued, so that the gain would be fully covered by private residence relief. He obviously hadn't lived in the property before completion, and in fact it didn't even exist for part of that period while it was being built. So what the Court of Appeal focused on was the typical case of an individual or a couple buying and occupying a property as their only home. And there's obviously often a period, more than a month, between exchange and completion, but there is nothing in the legislation that sort of allows a short gap between exchange and completion, and says that can be ignored when calculating private residence relief. So under HMRC's argument, the typical purchaser would be exposed to some capital gains tax, as they couldn't have occupied the property during the whole period of ownership. They couldn't have lived in it until completion. And what the Court of Appeal thought was that Parliament couldn't possibly have intended the private residence relief rules to work in a way that doesn't give complete relief from CGT in this sort of typical case. So they found that the period of ownership for private relief purposes only must begin from completion, which was an excellent result for the taxpayer, and it also reverses the upper tribunal decision that we saw previously.
Yes, thank you, Liz. That brings us to the end of our tax roundup and concludes our episode today. To hear future episodes, don't forget to subscribe to S&W The Pulse if you haven't already, and please rate and review us in the App Store. Thank you very much to our special guest Zoe Thomas and my excellent co-hosts Gina and Liz for your valuable contributions. And most importantly, thank you to our listeners for tuning in. I hope you found it interesting.
This S&W The Pulse podcast is of general nature and is not a substitute for professional advice. No responsibility can be accepted for the consequences of any action taken or refrained from as a result of what is said. The views expressed are not necessarily those of the presenter or of Smith & Williamson or any of its affiliates. No reproduction of this podcast may be made in whole or in part for professional or recreational purposes. No action should be taken based on this podcast, and we accept no liability if we change your views on any of the subjects mentioned.